Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend, the voice of the people, Jeff Santoro. Jeff, we have another gift for our listeners.
We do. We don't always do back-to-back interviews, but when we get the names we want to get, we do them when we can. So I am very excited. We have another guest today. So as everyone knows, the disclaimer is you get less me and Jason, so you're welcome. Congratulations, listeners. That's the gift.
It's the gift.
But the other gift is that we are talking with David Gardner, co-founder of the Motley Fool and author of the new book, Rule Breakers: How to Pick the Best Stocks of the Future and Build Lasting Wealth. Rule Breaker Investing. Sorry, I got the title wrong already. So let's get right to it. David, thank you so much for coming on. We're so happy to have you here.
Guys, it's a delight. We first had this conversation about doing this like 5 months ago, and I said I'd like to, but I have this book coming out in the fall. Can we wait till then? Because publishers always want you to start talking on podcasts right around when your book comes out. So Here we are, but I would have done it last April, and let's do it next April too. Thanks for the invite.
Yeah, absolutely. We're definitely looking forward to having you on, hopefully multiple times over the years. And little teaser here, folks, at the end of the podcast, the last thing we're going to be doing is a reason for David to come back in a year and a year after that and a year after that to check on us. So that's going to be a lot of fun. David, I'm going to ask you a question before we dive in here. Do you remember the first time we met face to face?
I don't remember the first time, but I have a couple of guesses. I'm thinking it was probably at a Motley Fool event. In time, Jason, you became a Motley Fool contracting writer, and so I think it was before that. I definitely remember meeting you and your wife at different points as well.
That was actually the first time that we met.
At in California?
That's right. And we were in Southern California, and I had just started doing a little bit of writing, freelance writing, but I was mainly just a member. I was doing the ticker guiding, right? So I was really involved with the community, that kind of thing.
Yeah.
But it was awesome. We were in town to, I think I was going to meet with one or two people internally for a couple of little things.
At the Fool.
My wife came. We have some close friends at the time that lived 5 minutes away from HQ. So she came down with me to check things out, and you carved out some time on your calendar, and we sat down. And I know you probably remember we sat down, the two of us, but here's the distinct thing that really stands out to me is we sat down and, we had our little cordial, little kind of small talk and that kind of thing. And then you found out that my wife worked in the biotech industry, and then spent the next 15 minutes ignoring me, talking to my wife with some deep questions. And it was incredible. It was so absolutely fantastic.
I'm going back there now. Were you guys in Thousand Oaks or near Thousand Oaks, California?
That's exactly right.
I do remember that.
You made the right decision.
Oh, 100%.
By talking to his wife and not him.
Yeah.
I mean, that's
far more interesting, much more intelligent. And honestly, if you look at her portfolio versus mine, she's a better investor too.
It's great to have two in the family.
Pays off.
And thank you for all you've done. Absolutely, Jason, for so many fools. Jason and Jeff, thank you guys for being friends of the Fool for many years. And I'm excited to be on your podcast.
So let's dive in here, David. I've had so many questions about rule breaker investing just generally since I first became a member myself. And so to have you on here and have a reason to ask them is super exciting for me. So one of the themes you have in the book that goes throughout the book is basically, I now have, 30 years of history or 25 years of history, however long since you started Rule Breakers itself, to kind of show that this works. So the question I've always wondered is, what gave you the confidence to invest this way, which goes against conventional wisdom in a lot of ways, back when you didn't have that track record to stand on? Like, what gave you the confidence that this was right when you were just first beginning it?
Well, I think for me, I did start investing at a young age, Jeff. So my dad gave me a portfolio the day I turned 18. And so while other kids were having fun in college, I was also having some fun in college, but I was also like overseeing and learning about my investing portfolio. So that build up from age 18 to 25, 6, when we started the Fool, I had been building up ideas. When we started the Motley Fool, we launched on AOL on August 4th of 1994. I would not have known what the phrase rule breaker investing was. I wasn't using those words yet. I was still learning my way into it. And obviously now at the age of 59, I continue to be learning my way into how to invest. Never ends. But I think it was somewhere in there when we had AOL in our portfolio. And Jeff, I learned so much from watching that stock, both since we were working with AOL. By no means were we required to like their stock or hate their stock. This was a completely independent decision that we made as fools. but we were working kind of behind the scenes with the big internet dog starting the age of, well, the decade America went online. And so watching the guts of that operation and learning about business from them while also being on tap for recommending the stock and watching it 2 consecutive summers be called the most overvalued stock on the market by it wasn't the World Economic Forum, but there was this summer meeting of economists that all got together, and then each year they would say, what's the most overvalued stock? And 2 years in a row, AOL got called. And in the meantime, it had doubled for us, doubled again, doubled after that. It ended up going up 150 times in value at its peak. And so that was like a living lab of why would this happen? How could people be so wrong about it? What can we learn? What patterns can we start to recognize that would help us see this in other things? And so to answer the question, possibly in too long and shaggy dog away, I would say that it was a process. And there was no moment where I was so headstrong or convinced, and I remain unconvinced by anything I write today, that it's always going to be right, or that I won't say something different a decade from now. But it was such an incredible learning lab as the online world got started. And we as young people were picking stocks out front of America, and people were following us, and we were being reported on in the media what we're saying and doing. And so it just accelerated our learning and put pressure on us in a good way to have to learn. And I learned so much, not just from that one stock, but mostly about rule breakers, starting with AOL.
I think one of the things that stands out to me about, AOL is a good example, and you wrote in the book, the one that's definitely the most in the zeitgeist right now is NVIDIA. But when NVIDIA first came on your radar, the idea of large language models, those things didn't exist, right? So we weren't even thinking about that, just the idea of this disruptive technology that has lots of capabilities. But I think the core to me is this evolution of the rule breaker is like right at its core are these kind of transcendent businesses that over time, it's not about just a binary, it's right or wrong. The optimal right answer erases 50 wrong answers and you still triple your return, right? It's the power of finding the one or two that can be generational in the kind of value that they can create.
For any one of us, just one of these stocks, one stock that goes up 100 times or more in value on its own will probably lift your portfolio to market-beating lifetime returns and possibly, at least as for me, wipe out all your losers and still leave money on the table. Mm-hmm. But I was never trying to be a one-trick pony or the AOL guy or the NVIDIA guy or the Amazon guy. I've tried to identify rule breakers, put a name to them, give the traits that I look for in them. And as you guys know, having seen the book, it's not just about the stocks. In fact, I really make a big point in rule breaker investing of leading off with the habits that we need to develop as investors. Because one of the things, Jeff and Jason, that we've done over the years is we've said stuff like buy Amazon or buy NVIDIA. And that's great advice if you look at the history of the returns. It's just, these are the best stocks you could have owned. And yet, if you're a Motley Fool member and you didn't come in with proper habits, or you weren't even a Motley Fool member, you didn't even know about investing, and you just sort of traded in or out of it after 6 weeks or one drop, then that wasn't great advice for you. You didn't get Amazon or NVIDIA. But for those who did, identifying what it is about these companies that is going to be so transformative, not just for our society, but also for your financial freedom, that's been what I've been hunting for a long time now.
One of the things that you wrote about in this book it's definitely not something you've led off with the other books that you've written is the holding part, right? How important it is to hold and then hold a little bit longer and then hold even longer than that. And you just hinted at that for people that join a stock picking service and subscribe to it, having that capacity to be able to continue to hold. So I'm curious from a personal perspective, your capacity to do that, find these great businesses and continue to hold. How did you develop that muscle, right? How much of it was just intrinsic and how much of it is a skill that you've developed over time?
Well, I definitely didn't start with it because when I started at the age of 18, my basic goal was to buy a new stock and maybe hold it for 18 months and try to double. And then if it did, I would probably be selling it to move it to another stock that I hoped would double in 18 months. That was my 18-year-old mentality. So from that standing start,
simple, right? It's easy. Just
You know,
just pick the ones that double.
It feels great. And it was possible to do that. Like I found TCBY was like my first early star stock, the country's best yogurt.
Yep.
And that had an incredible summer of 1986. But with that said, it's exhausting to jump in and jump out like that. And you're foregoing finding the truly great companies when you're just going with the TCBYs or whatever seems like a good idea at the time. You're not asking yourself, what are the world shapers? What are the companies that are going to matter to everybody, that would pass my snap test, something I write about in the book. And so you change the nature of what you're picking when you develop a long-term habit. We've always been long-term oriented at the Motley Fool. You guys know we've always been business-focused investors at the Motley Fool. But it was really just through the example of what we did in our services, like holding on to Amazon in Motley Fool Stock Advisor, holding on to Netflix as Quickster happens, holding on to NVIDIA as it loses 2/3 of its value 3 years ago. These are things that we learned over time. And I think the key, Jason, is that they're usually the stocks might be having a bad time of it, but when you actually look at the underlying business, it's not that bad.
Right.
Quick example, Netflix got destroyed. I think it was the summer of 2011 when they announced Quickster. We won't go back over that. A lot of your listeners will already know that. But basically, the stock in about 6 months lost 2/3 of its value. Now, Netflix, the business, had something like 25 million customers at the time. And during that horrible 6-month period, they went from like 25 million, check it, to I think right around 24 million. In other words, they lost 4% of their customer base. Now, the stock got crushed in part because people expected it to go up dramatically from 25 million and it went down.
Right.
But it's
Messed
not
up
like
expectations.
it's not like the thing caved in. I would say more than anything, watching my recommendation of Amazon in the 1990s go from 3 to 95, and then in 2001-2 go from 95 to 7. And we're just sitting there, and our members have followed us in all the way up and all the way down. And I'm still sitting there going, I mean, I wasn't expecting this to happen, but I still like Amazon, the positioning. Jeff Bezos is still there, et cetera. So I would just say it was learned through kinetic energy, the actual doing of it, the holding. And the funny thing, as you guys know, is it's not like it was anything dramatic. It's not like I did a triple lots or made the right market calls. I just sat there and did nothing.
Yeah.
And I just held on with conviction. And I realize a lot of people think that's hard to do, but I find that much easier to do than the opposite.
It's funny that of all the aspects of rule breaker investing that I found resonated with me when I was just finding out about it, that was one of the ones that I connected with immediately from the standpoint of I'm a contrarian by nature. I like to question everything that it comes at me. Even if I ultimately end up agreeing with it, I have to question it first.
Love it.
And
so what he actually means, David, is that he's a curmudgeon and a pain in the ass.
That is true. No, but when I was a baby investor, just learning how this all worked, I would be drawn to the big moves, right? A stock goes up 15%, drops 20%. And if something in my portfolio dropped really big in one day, I would always try to find the reason why that had to be wrong. And I would go look at the results. And what I learned was kind of what you just said, which is a lot of times the stock moves because of emotions. And I would look at revenue was up and they beat their guidance and they raised their guidance. Like, I don't see what the problem is here. And then naively, I would just move on and be like, well, the market's wrong. And I actually have become a little bit less carefree in that way as I've gotten more experience, but like my like brand new investor brain where I was questioning everything. So then when I kind of found out that this is a thing actually other people know and believe, I was like, oh, okay, that made sense to me. It clicked. So that one always resonated with me. So let's pull on the string a little bit more though of holding for really long periods of time, because I know you're known for holding, but obviously at some point you've sold a stock. So I'm curious, when you do go from holding to selling, what's that process like? What are the things that you do take into consideration that actually get you to the point of saying, okay, this stock has come down, it's over for this story, I'm out?
So thank you. Great question. I think there are 3 cases where I might typically sell. And you're right, Jeff, I don't do it very often. The first is the best reason of all, the stock is blowing up in the best way and it's going up 20, 30, 50, 100 times in value. My cost basis of 16 cents in Amazon means it's up more than 1,000 times in value. My cost basis in NVIDIA also 16 cents. Coincidentally, really fun fact, but that's also up more than 1,000 times in value. When stocks explode like that in your portfolio, you're probably selling, and you're probably selling on a recurring basis. And so that's my favorite reason to sell. And that's when I've sold the most often. The second reason to sell is often because you no longer believe in the company that you're invested in. It's begun to, if you've set up an initial thesis and things that you're looking for, and those things start not happening, then often near the end of a year, when I'm selling off some of my big winner, I'm also selling off losers to net out the capital gains and reduce my capital gains tax burden. So that's reason number two, is that the company is just not what I thought it would be.
Is that a slow process for you, or are there times where you reach that conclusion relatively quickly?
No, I would say it's a slow process, Jason. I always think of myself as the last out for any bad stock.
Yeah.
And it really doesn't trouble me. And this is another important moment in the book, but I think so many of us naturally just fear loss, and we fear really bad loss. And so when something drops 80% in value, that feels like a disaster that you want to get out of. But because investor habit number two for rule breakers is add up, don't double down.
Right.
I basically never add money to things that are down. So if something drops 80%, I'm not the guy saying, I'm right, market's wrong, I'm going to keep plowing more money into this. That is almost, guys, the only way to go poor investing in the market. There's almost no other way. Because even if you just sit there and pick mediocre stocks or sit on your index fund for years, you're going to go up. The only way to lose a ton of money with the stock market, sports betting can be done overnight, but the stock market would be to be adding to something that is dropping and that will never come back. And that is so sad when that happens. And I will never make that mistake with my portfolio. And so I'm happy to allow something to be sitting there down 87%. Oh my gosh, now it's down 92%. But as you guys know, since we haven't added, if it's already lost 0.8 of its value, it has very little effect on my overall portfolio. For it to go down even more really doesn't matter, Jason. So that's why I'm kind of the last guy out a lot of the time. And, obviously I try not to do that at all. My goal is never to lose with any of my investments, but I'm willing to lose in a way that I think few people typically would be. But I'm using math.
Sometimes it can take those stories time to play out, right? So that's another reason I think it's part of the value of holding longer, because there's more we can learn. And if the business is still showing signs of the things that we want it to do, the incentive there should be to continue to hold those businesses. I know an example that you're familiar with is Activision Blizzard, right? This is a business that for the better part of a half a decade was a terrible investment. Even though the business was doing relatively well, there was the overhang of a majority owner that was drastically affecting the business's ability to be what we all thought it could be. And then when those handcuffs came off, those of us that were patient were incredibly well rewarded over the next half decade.
You're right. That's a great example. And part of being an investor, I hope over our whole lifetimes, is stacking up learnings like that and beginning to recognize patterns that you can see from the past that you've lived because you made choices. You bought Activision Blizzard. You, with me, maybe bought Zoom video communications and you watched it zoom in the craziest way up and then get absolutely crushed. And you're able to just put that in with, the Pelotons, but also the Netflixes, another stock that got crushed but came back. And you're starting to ask questions and understand why these things happen. And you guys know that, we always, as fools, proceed from a place of humility. And I never go into any single position or recommendation over years to our members, headstrong saying, I'm right about this one. I think the healthiest thing we can do, not just in investing, but in life, is to think we're right whenever we do something and know some of the time we're definitely going to be wrong and not know which of the times that is. That is such a good place to come from as an investor.
About a year ago, we were all at Fool Fest together, and you were on stage talking about NVIDIA, and you said to the crowd that you've bought it all these different times after it had gone up, after it had gone down, and you'd buy it today. And I remember standing in the back of the room thinking to myself, all right, I get it. David's the guy who adds to winners and all that. But man, does he really think it's going to go up from today? And it has, right? So this is an introduction to ask this question. So in the book, you talk about buying Intuitive Surgical, I think at 71 times earnings. And you had a whole great chapter or part of a chapter about valuation. But the question I've always wondered is, there has to be a point, I would imagine, at which you do say, okay, at least for right now, this is too overvalued. Like I imagine that as much as you are ignoring that most of the time, there's got to be a point where it's too much. So I'm just curious, like how you think of that. Like, is there
when
a
does
point where it's
valuation
too much?
switch from being like a signal to a caution?
Yeah.
It's such a fun question, and I'm coming at it from a different angle, and I hope this is effective. When I buy Intuitive Surgical at 71 times earnings, I'm buying into a stock that is overvalued. It's already overvalued. This is where we're headed. When we buy Starbucks, and people are like, I would never pay that many times for a coffee company. By the way, the coffee itself is overpriced. I'm like, okay, so I've just bought another overvalued stock. That was true of AOL. It's true of so many Tesla. It's true of so many of my favorite stocks that have gone on, guys, to be my best investments. And I would say in a lot of cases, the best investments you could have made on the stock market. So I actually proceed from a place that it already is overvalued. So when you say, but David, I mean, at a certain point, it's overvalued, I start by saying it always was. And then we get into what we mean by valuation. And that's maybe my favorite part of the book. And maybe the most important part of the book, chapter 12, where I talk about what overvalued really means. And we can go too long on this point. So we're only going to spend time here, more time than normal if you guys want to. But what I would say that I have learned, because I've watched AOL be the most overvalued stock in the market, and then it went up 150 times in value. I've watched Amazon be overvalued from day one, and it's always been overvalued, and it's up more than 1,000 times from where it was overvalued. You can imagine, I just don't think we're thinking right about this. And I would say if I tried to, at one point in the book, in chapter 12, I'm like, so why is this? I think now I've observed enough that I think I know what it is. And without fully explaining right now, I'll just say, I think we're not actually looking at all the things that are part of a company when we value it. And so if we're only looking at earnings or cash flow, or primarily saying it's X times earnings or cash flow, those are outputs, those are outcomes. And we're missing all of the inputs that exist at that company, that will continue to be the case at that company, that don't have line items anywhere in the financial statements. And so we've lived our way into a world where most of the people who are valuation experts are saying all of my stocks are overvalued, and all of the stocks that were ended up being my best stocks. And it's all part of the public record now. So I think there's something to learn here. And as I try to learn it, I think we're not looking at least 4 things that are the most important things in business, and none of them is being valued. Therefore, all of our math is wrong, not for every company, but for the rule breakers, the ones I focus on. And that's kind of where I sit with the, isn't it already ever overvalued?
Let me ask it this way, and you tell me if I'm misinterpreting. I hear you say it's less about what the actual number is, 71, 103, 84, and more about the intangible things that are contributing to that number.
I would say yes. Generally, that's true. I'll give a quick example. Who's the CEO? There's no line anywhere in the financial statements for who the CEO is.
Right.
There are some CEOs who are literally incalculably valuable.
Yeah.
Jeff Bezos.
Mm-hmm.
And then there are some CEOs who are bad CEOs destroying value at the companies that they're the CEO of. And when you think about what are the most important things that would drive the future value of any company, the CEO matters. It's not even necessarily the number one thing for me, but it's way up there. It's kind of like the quarterback in the NFL. They're the most important player, even though I personally think quarterbacks are overvalued in the NFL. But just sticking with it, we all know who the quarterbacks are in the NFL as it kicks off next weekend. But we don't know or care, apparently, who the CEO is, because there's no way to put a number on that. Therefore, when we say Amazon's so overvalued, if you invented a proxy, if I'm doing this visually, but if this was the earnings little bar, and then you have Jeff Bezos, I would stack Jeff Bezos on top of that. I would make that a bigger bar than the earnings.
Right.
And now my price multiple off of that is way lower than most people would think. And that's just one of at least 4 intangible factors. Intangibles sometimes sound like something you can write off, or it sounds like an accounting term that we're all supposed to study if we're going.
Yeah, no, it's probably the wrong word to have used.
No, I didn't mean that at all, Jeff. No, because I use it myself. But I am here to say intangibles matter more than tangibles. Literally.
Yeah.
Way more. Who the CEO is matters way more than the present cost of oil or the tariff effect These things all matter, but we're not even paying attention to who the CEO is in our financial statements. By the way, I'll just give a second one. The brand. The brand of a company like Apple, the greatest brand in the world, by the way, no surprise to me, I hope you guys either, that the greatest brand in the world would also be one of the world's most valuable companies. These things are directly tied to each other.
Yep.
And Starbucks is powered by a brand, and so are most of my great rule breakers, Tesla, and no one's valuing brand. And so, of course, they end up looking like crazy overvalued, whereas I'm sitting there going, we've got one of the great visionary CEOs, the smartest guy in the room in this industry. We've got a great brand. There's some other things too. No one's valuing those things. So that's why I think 71 is off in the first place. And so whether you're 104 or 63, it just doesn't matter as much. It does matter. Everything matters, but it doesn't matter as much if you're holding the stock for a long period of time as the things for which there are no numbers when those things matter most. And that's definitely a theme of rule breaker investing that only starts emerging in this book because it took me 25 years to pick all these stocks and see what happened and be told I was wrong. Or I'm overpaying constantly for all these companies, and then they end up being the top 10 stocks of the last 20 years. And I'm sort of like, what are we learning from this? And by the way, sellers are holding these, and I'm still holding.
I have some observations on this I'd like to hear your thoughts on, David. So number one, I think as investors, one of the things that happens a lot is we use the wrong tools for the job. And then like all mediocre craftsmen, we blame the tools when the output is mediocre, right? So and in the case of valuation, I think when you're looking at businesses like Amazon in 98, or really any time up until maybe the past few years, valuation was less important than the company's ability to deliver on, in a lot of cases, things that nobody could have really expected. And the magic of a Jeff Bezos, when he was there, was the vision, and Reed Hastings, the same thing at Netflix, their ability to see, mix another metaphor in here, where the puck is going to a certain extent, and their ability to do things that can make money that might disrupt other parts of the business, but are so potentially valuable, like AWS, coming out of that mentality of like being your own first best customer, building out all this cloud infrastructure, and then realizing we're kind of sitting on a gold mine here that we could sell this, right? We've built all this capacity for last mile logistics. We're sitting on another gold mine here that we can leverage for other sellers, right? And then Netflix's willingness to disrupt its own business. We saw that with Apple, right? They've always been willing to disrupt their cash cows because of the tacit acknowledgement that if we don't, somebody else will, and it took Microsoft wandering through the wilderness 15 years and finding the right CEO that was willing to tear down all of those silos and disrupt that core, selling operating systems and trying to monetize what made sense for 40 years but doesn't make sense anymore, right? So thinking about all of those things, it's what's going to happen over the next decade is more important than what's going to happen over the next 12 months. And that myopic, 71 times next year's earnings for a business that could be 50 times larger in 15 years is the worst case of using the wrong tool for the job, as I view it. And that's your philosophy. You've always done such a good job of making it clear. Of course, clear and simple isn't easy, but making it clear that the vision of what the future that you want to see, right, that you've talked about so much. So all of those things, as I've just kind of put all of that out there, so much of it is about what are you trying to do? Are you trying to measure the value of what exists today? Or are you trying to measure the value of what it can be? And what are the ingredients that can make it there? And are you valuing those ingredients properly because you've got the right leader to combine those ingredients to make something powerful?
And I think most of the great leaders are what they're doing, and you just gave some great examples, Jason, is they're innovating.
Yeah.
And so another thing that is nowhere on the financial statements is how innovative a company is. And yet, does anything matter more than that? I'm not sure the CEO or the brand matters as much as a culture that is innovative. Each of the companies that we've talked about, I think almost to a stock, is a company that's transformed itself multiple times, especially since I'm trying to hold stocks for 30 years, not 3 years. For those that we do, you watch these companies just transform over and over again. And Amazon is the best example of that. But NVDA, which I first recommended on April 15th, tax day of 2005, was a video game graphics card company.
Right.
And by the way, when I picked both Amazon and NVIDIA Amazon was a bookseller and NVIDIA was a video game card company.
Right.
And in no case did I or those CEOs know what AI would be, LLMs, or would we know what the cloud would be in the case of Amazon. So it's not like I'm some sort of visionary genius who's seeing the future at all. What I am doing is I'm looking for the factors that I believe enable companies to succeed wildly and to break out of the boxes that people try to hold them in, especially valuation boxes, but even just competitive boxes. One part of the book, I start talking about how Walmart was going to bury Amazon. And then Walmart was also going to bury Netflix because you could just drop your DVDs off at the local Walmart and not have to mail them back to Netflix. And that was going to bury Netflix. So in both cases, I'm sitting on those recommendations with our members publicly, and they're reading headlines that are saying Walmart's going to crush them. And in no case could we be sure either way. But what we're looking at are the factors that enable companies to succeed wildly. And I think that's what rule breaker investing is. And it takes the people to do it. Like the true heroes are the CEOs who create these innovative cultures. And as you mentioned, Satya and Nadella, even if they're not a founder, they're showing up and they are changing the game for everybody. So, especially NVIDIA as a video game graphics card maker and Amazon as a bookseller is so instructive to us as people who've held for 20 plus years these stocks, because you just learn so much. It's like an MBA course on steroids, and you're multiplying your money many times, even though you have lots of losers right alongside them, guys. And I'm guilty at some point of talking too much about winners at this point, because losing is a really important part of being a rule breaker investor. And I have more bad stock picks than anybody in Motley Fool history. So I always want to make sure we're not over talking the ones that have worked. But you guys know the ones that work wipe out all the ones that don't. That's such a key learning.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
One of the things I've been wondering as I was reading through the book, you've been talking publicly about picking stocks for a really long time now, within the Fool and even outside of it. And I think rule breaker investing has become something that people outside the walls of the Motley Fool are becoming familiar with, and certainly more people will after this book comes out in a few weeks. I wonder if you see people misusing or misunderstanding aspects of rule breaker investing as you are, I know you're active on social media, and you must see people quote you and attribute things to you. I'm wondering if you ever see people misunderstand or misuse aspects of rule breaker investing, and if there's any common threads.
That's a fun question, Jeff. And I might ask you back because you guys are familiar with this work. So if you're seeing something out there, I'd always love to hear that from you. My short answer might be that, first of all, as Jason spoke eloquently before, any tool can be misused. So it's not the fault of the tool. It's going to be the fault of the user. And I think we need to know to use the screwdriver, not the hammer in certain situations, and vice versa. And so for me, it almost doesn't matter what we're talking about. Anything can be misused. I would say there might be a tendency for some to view what we do as momentum investing. Sometimes people think, they're buying the hot stocks. They're recommending the hot stocks, or, we have most or all of the Mag 7 so-called in our portfolios. So it might look like we're chasing yesterday's gains. until, and I hope you guys know this, we've had long holdings in those stocks for 10 or 15 years each. And so sometimes I say, what's your Magnificent Seven score? And the answer is the number of years that you can add up your holdings of those stocks. If you were to combine them all, how many years have you held the Mag 7? That's your Mag 7 score. And so when I say things like the third trait of the rule breaker stock is stellar past price appreciation, which is a really contrary concept, and one of my really fun chapters that I loved writing in the book, it can look like we're just going after whatever's hot, whatever's on fire. It's overvalued. It's probably going to come crashing down because, guys, what goes up, right? And so people have that parabola mentality when I actually think it's more about a hyperbola. If you look at hockey stick graphs of great stocks in the market overall. So I might say, Jeff, that there could be a danger or a misuse of this to think that you should just buy anything that is overvalued, hot, and looks like it's had a great chart. And I don't even care about charts, but I do look specifically for stocks that are winning. And I ask which are the ones that are going to keep winning. And so, yeah, so that might be an answer. But Jeff, have you seen something out there? Jason, are there ways that you guys think that this tool could be misused?
I don't know that I see it specifically just with rule breaker investing, but I see this with almost anything out there. I think it probably happens a lot with Buffett quotes, which is someone wants to do something or justify something they've done. So they find every possible quote out of context that can
Confirmation
what
bias.
they've done.
Yeah.
Such a powerful thing.
Yeah. I have a lot of fun with that in the book. And at one point I mentioned that if you just attribute anything to Lincoln or Churchill, you're instantly going to be right. And, I do. There's at least one Buffett quote that I directly, I hope, very clearly take down in the book. And yet, few people have as much respect as I do for the man, even though I take a totally opposite view. So I agree with you. Those notable quotables that could be memed out and, tiled up in social media that can justify almost anything can lead people down the wrong path.
So we're going to play a fun game in a few minutes, and you're going to be our judge here, or at least our commentator. But we have one final question we wanted to ask about. I love the anecdote in the book about the odds that Secretariat had, and then the odds that maybe an unknown horse that won a race, 80-1, something like that. So as you think through all of the stocks you've owned, picked for rule breakers, owned personally, what's one that stands out to you as one that you were convinced was Secretariat, right? This is going to win the race. I have no doubt about it, and disappointed you. And then on the flip side, what is one that you still recommended, but maybe deep inside were like 80-1 odds that this one becomes a big winner and it completely surprised you?
Well, it's funny because having picked just hundreds and hundreds of stocks over 30 years for the Motley Fool, I have too many answers to that. And yet my memory is so bad, I'm like, it all washes together. But a couple things come out right away for me, Jeff. The first is, I want to preface this by saying I never actually go in thinking something's going to be a mega winner. I hope you've already picked that up from me earlier in the talk. I go in from a place of humility saying, I like this. I like the factors I see present. Let's make this our next recommendation to members. Let me make this the next stock that I buy. You will never find me, I don't think, ever pounding the table saying this is the stock. And that goes for my very best investments, Amazon at 16 cents, NVDA at 16 cents. I wasn't pounding the table. Those buy reports are available for anybody to read in either case. So it's not my nature to go in headstrong and think I'm right. With that said, times that I've had high confidence are often where I make an initial recommendation, things start going really right, and then I'm like, we're going to add to this because that is habit number 2 of the rule breaker investor, add up.
Yep.
And then sometimes it goes the other direction. So a number of times I've done that, and I apologize to Motley Fool members for when, we identified something that looked like a rule breaker, that we added more to it, and then it ended up being a faker breaker. And many examples come to mind, but right off the top of my head, 3D Systems in 2016 was as 3D printing came on as a new technology, which I think is fascinating and is a bigger deal today than it was back then. But the hype cycle being what it is, it was definitely in the headlines. And I recommended the stock as a rule breaker. It went up 8 times in value in a single year. And then we later sold at about a 90% loss. And so that would be a great example of one where I had confidence in it. I loved it. I mean, the stock was up 8 times in value. I loved it. But it's not like we started going crazy or saying this is going to take over the world. Sometimes they keep going up way more than 8 times in value, but I've seen it happen enough times. I'm willing to let both play out and hold. I do think many people would never, ever, ever want to make 8 times their money and then sell at a loss. And while I absolutely hate that that happens, I'm totally willing to allow that to happen, because I know the ones that go up 80 times in value, if you do the math, you make so much more money by holding both of those, even though many people would be devastated by the notion that their 8-bagger became a loss. So, I mean, I would say Zoom was one that looks so beautifully positioned as it helped save the world in the pandemic, and a good company, something we take for granted today. Many of us use it every day. Been a real dog. It's gone sideways for 3 years at a fraction of where it was during COVID. Peloton, GoPro, the list goes on of stocks that were rule breaker-like, but ended up being not rule breakers, but faker breakers. And then quickly to answer the other side of that, again, I could talk too long about this, but I'll just mention Booking, which was Priceline back in the day. For those old enough to remember William Shatner,
Yep.
singing in support of a stock whose shares he was given some of, Priceline, late 1990s, early 2000s. I recommended it after it had kind of gotten knocked down, and I recommended it at a point where it was the 3rd biggest player in the online travel industry. Looked like sort of an also-ran, and my thesis, if you go back and read it, was I think this is going to get bought out by one of the bigger dogs, and that's why we're going to buy the stock today, because I think it's going to be acquired. And it never was acquired. Instead, it started buying out others. It bought Booking, the dominant service in Europe, etc. It renamed itself Booking.com. It became number 1 and went up more than 100 times in value. And I was completely wrong in my opening thesis. But my tendency to still love innovators with good CEOs who have brand names and understand how to market to people and just keep holding those, even if we're wrong, it clearly blew away any expectation I ever could have had. So that itself is a wonderful lesson. Each of these is such a good lesson. And that's why I love, guys, and I know you do too, buying stocks directly, because you don't learn a lot from index funds.
Right.
And I realize a lot of people do that, but I think you rob yourself of so many great learning experiences and a lot of fun if you don't buy stocks directly.
If you study the businesses and not the stock charts, right? That's the key, is study the business. Study
That's
the
what's all used
videos.
to investing.
Yeah. No, that's exactly right. One thing I want to just point out, David, I think it's really compelling, is everything you talked about. There were no flaws there. There were no bugs. Those are features of your style of investing. And I think successful investing writ large is you have to acknowledge that you're going to make mistakes. You know, you mentioned Warren Buffett. He's probably written more words about bad decisions he made than winning investments that he made, and having the humility to learn from those mistakes. I read an interesting story about a college football player, a quarterback for, I think, Iowa State or something like that. And his humility, and he talks about a lesson he learned from his mom when he was 8th or 9th grade. He was a small kid. He didn't make the team he wanted to make. And she said, look, you win or you learn, right? Not win or lose, you win or you learn. That really resonated with me. And that's such an important part of a successful investing process. Having that humility, acceptance that you're going to get it wrong, but what can you learn from those mistakes that you can apply, as much as what you can learn from the winners that you can apply to find more success.
Well said.
All right. So, David, I know that you stepped away from stock picking back in 2021, but my favorite part of your podcast, Rule Breaker Investing, and by the way, everyone should pause right now, go subscribe to Rule Breaker Investing podcast, and then come back here.
We'll wait.
We'll wait.
Yeah.
But I really loved the 5 stock samplers you did for a bunch of years. I thought they were super fun to listen to. And one of the things, we do a lot of fun stock picking games on our podcast.
Right.
They're all short-term-ish, although we do keep score over the longer term, but we've only been around for 3 years. But the reason we like doing them is there's so many lessons you can learn just in a month, goofy stuff that happens. Like, hey, I was down 80%, now I'm up 100%, and it's only been 90 days, right? So we're going to pick 6 stocks, Jason and I, 3 each. We're going to call this the Smattering Six, because our podcast used to be called The Smattering before we rebranded and became Investing Unscripted. These are stocks that we think are rule breakery, and they may or may not actually be rule breakers like actual picks, but we think they have rule breaker like qualities.
Great.
We'll see what you think. And then if you're willing, we'd love to have you on in a year, maybe on the anniversary of the book coming out or close to it. And we can revisit, Jason and I, our stock picks.
I love stock picking contests. I think that's fantastic. A problem of them, and school kids know this, when they have this little plug-in unit with their social sciences, where they're for 2 months going to pick stocks, and whoever basically picks the best penny stocks with the Marcos up or down, is going to win. So, I mean, I love the game of it. It can be a little silly, but at a dead minimum, 1 year's time, I think is a good learning unit. So I love that you guys are talking about this. And even in shorter term contests, a lot of times we don't even have to make it about the stock, guys. We can make it about outcomes. For example, what will the earnings of this company be? Or of these 5 companies, which will have the biggest surprise? That doesn't force a stock market outcome, but it's the key input that drives stock market returns. So I think it's great to be always speculating. ABS, guys, and I think this is a lot of fun, and I'm looking forward to hearing your respective picks. Let's do it.
Before we get going, David, one of the reasons that you decided to step away from stock picking is the Motley Fool Foundation, something you've become more involved in. I know is close to your heart. And what I want us to do is I want the loser of this contest to make $100 contribution in the winner's name to the Motley Fool Foundation.
I love it.
In a year.
All right. I'm
Okay.
in. I will happily watch you write that check year after year after year.
There you go.
All right. You go first, Jason. Age before
Okay.
beauty. You can do the first stock.
That sounds good. So David, you're going to be playing the role of Lisa Ling. I'm just going to let that hang out there. Folks, when you read the book,
Yeah.
when you read the book, it makes sense. You know, you haven't had your hand in the game as much, so
Perfect.
maybe not familiar with all these. So,
Perfect.
all right. So the first one I'm going to do, this is it's a newer company, and it's very much in the, my vision for the future, for a better world. It's a company that I think can do well by doing good. It already has. I do have a little bit of personal connections. I know some of the executives there personally, which can easily color your vision about these sorts of things, but it actually made me far more rigorous in researching this company. But it's a company I added to my own portfolio sometime in the past year. It's worked out really well. That's Transmedics, ticker TMDX. So Transmedics is the company that developed technology for transplanting organs. That's a game changer to make the organs more viable and also viable for longer, which means you can get organs farther from the donor to the donee. And the business has done extraordinarily well. Now they've done some operational things. They've bought an aircraft fleet to have more vertical integration. So Transmedics, that's my first one. What do you think, David?
Well, first of all, there are a number of things I can't look up on the fly, but I would be checking right now to see how well the stock's doing. I like to see a stock winning into my recommendations. So I'm not going to do that for each of these because it would take too long for the podcast, but that's a factor I'd look at. I already am familiar with the business. I know that a lot of people have called it as a potential rule breaker. I like that it does lead to a better world. The idea of organ transplants and transportation, it's a complex business. The question I would have for it, not trying to grade each one of these, is basically how scalable is that?
Yeah.
A, how much true need is there in the world? And then B, how much can they fulfill that need? And do they have a blue ocean opportunity where nobody else can really compete? Those are the things I'd be looking for.
Yeah, no, those are good. I won't spend a lot of time answering them here, but that's actually one of the things that's compelling to me is by that vertical integration, they can double their capacity just by adding a second shift to their fleet, for example, their aircraft fleet. So just a North American business now, there's a lot of room to grow. One of the reasons to me, it's a $3 billion business. Global organ transplants is a massive need, massive industry. Could it be disrupted in the future by technology? Sure. That'd be awesome if that happens.
Right. One of those businesses you want to root for so they go out of business, right? And they get to a point where
because it
you
means
don't have
we
to
come
worry
up with
about it.
something even better.
Yeah. All right. That's a good one. I'm going to go, this is in no particular, this is the order I thought of them actually. There's my particular order. So my first one is Warby Parker, ticker symbol WRBY. This is a David and Goliath story, as I understand it. Pretty much any brand you can name in the world of glasses is owned by one mega conglomerate.
Exotica, yeah.
And Warby Parker is sort of the David to that Goliath. They are a B Corp, so there's a charitable aspect to their corporate structure, and they provide inexpensive glasses for people. And I've been a customer for much longer than I've been a shareholder, so I've always been interested in the company. Still early games as a publicly traded company. I think it's only been on the market a few years now. I wouldn't say they're a top dog and first mover, but I do think that they have a competitive advantage in the sense that, especially if you have kids, like my younger son just got glasses, and the idea that I bought him $95 glasses and not $395 glasses was very appealing to me because I'm sure he will break or lose them at some point. Price appreciation up 95% over the past 3 years. The market's only up about 54% over that same amount of time. So I think it checks that box. Not all of them. We're not going to go through every single aspect, but that's my first pick, Warby Parker.
It's a really fun company. I like that it is one that a lot of people can relate to. We have direct experiences with them. We can go into their stores, and they do have stores, although, of course, the online business is really big for them.
Mm-hmm.
It's well down from its IPO. It came out at a maybe not great timing for it, but the company overall has always looked solid to me. You're looking at it more than I am, Jeff, but I mean, I think both of these are compelling possible rule breakery stocks. Yeah, a market cap of $3 billion is not a big market cap. So this is still an early stage company with a brand that punches above its weight class.
I will counter your note, David, about it not being a great IPO. It was a great IPO for them to raise capital. Right. It will not be for shareholders that bought when shares started trading. So, okay. All right. So here's my next one. I'm going to go back in time here, David. This is actually one of the first rule breaker stocks that I bought. Now, at the time, it was called BofI Holding. Today, it's called Axos Financial, ticker AX. This has been a massive winner. Certainly one of the first movers in banking to go to an internet-only model, and one of the few that's still truly an internet-only business, even though they actually do have one branch because of an acquisition they made, and they're trying to get rid of that branch. But it's a story of optionality and a great CEO in Greg Garrabrants, who came in during the financial crisis when they were just a jumbo mortgage lender in Southern California. You can't think of many worse situations for a bank to be in. You have this transcendent leader that came in that saw the potential just to be good at banking, but doing it on the internet and then expanding into more and more lines. And it has been a massive market beater. It has been a huge winner. And it's been a great average up story for me. I have bought the stock often at better valuations, but at a higher stock price, probably 24 times over the past roughly 15 years. And I think even with all of those returns and growth, it is built to continue to be a wonderful market-beating business.
Well, it's a company that I definitely know well because we brought it to Rule Breakers in 2012. Mm-hmm. So yes, we have a 13-year association with it. And it's been a 13 bagger just about over that time. And there's been volatility at different points. Jason, I want to credit Matt Argesinger at the Motley Fool for being the first person to bring it to Rule Breakers. It's funny because in some ways, I always thought it would be even bigger than it is now. It still feels like, Bank of the Internet, BofI was sort of how it started. And think about the positioning and power of that brand. And then to say, it's Axos Financial now, has always felt like a step down, even as it went up over time. So I think it's a quiet company. It doesn't feel like a rule breaker to me anymore, at least in a classic sense.
That's true.
It's no longer positioned as a top dog and first mover in anything that I could really point to. Right. But I would just say it's a solid company. I mean, I wish every one of our stock picks is up 13 times in 13 years. I'll take that every day.
Absolutely.
So congratulations on finding and holding a stock that has done really well for you. And it'll be fun to have this as part of your 3 stock portfolio a year from now.
All right. My next one, David, is I think the least rule breakery, but it's one that I really like a lot. It's a company called PCOR, PCOR, and they are essentially trying to modernize the construction industry. So I have a little bit of experience with this in my day job. I was in meetings about a big construction project for a school district over the last several years, and I watched firsthand in these construction meetings how much of this industry is still paper, pencil, photocopy, fax, email, PDF, and there's so many stakeholders, right? There, for us, we were the school district, there was the contractor, the subcontractor, the architect. It was crazy. PCOR is trying to put everything on one platform so that all of that communication can be in one place. It still has a lot of work to do if we're going to go through the rule breaker trade. So it doesn't have the past appreciation yet. I don't know about its sustainable competitive advantage. I do think management's great. Co-founder is still the CEO, although he's about to step into the executive chairman role. So I think it's got some work to do, but it seems to me to be in an exciting aspect of an old industry, right? They're trying to modernize it. So that's my second pick, PCOR.
Well, my question back, and first of all, this is the first one that I really haven't looked at, so I know very little about this. But my question would be something along the lines of, how are you scoring their innovative capability? What's the breakout potentially? Could you see them, if they're a worm right now, could you see how they are about to become a butterfly? Not every great stock ever needs to be more than a worm. There are a lot of worms out there. They've been around for thousands of years. Worms do just fine, but often we're looking for that transformative opportunity. So just because a stock doesn't have that doesn't mean it's not going to be an even better investment than some of my rule breakers. And you guys know that. I mean, rule breaker investing is solidly about a certain type of company that I focus on and that I fill my portfolio with and that I think lead to the greatest returns you can get from the stock market. And there are so many other good stocks that have less volatility or pay dividends that help people. This is I see it's a $10 billion market cap, so it's a little bit bigger, for example, than your Warby Parker. It's obviously much less known than Warby Parker, but it's 3 times its size and it still has the founder. Although I'd also say there's not a great public track record for this stock really performing. And to me, a classic rule breaker positioning is a stock that keeps hitting new highs and everybody's calling out as ridiculously overvalued as Palantir, as it just keeps hitting new highs and becomes one of the great stocks of a generation. And I'm not saying Palantir will, but I'm pointing out it's often called dramatically overvalued. It has been all the way up. It's been a phenomenal rule breaker like stock. So that's more the classic rule breaker, newer stock to me than a company like PCOR. But even if PCOR doesn't fit the rule breaker mold for me, doesn't mean it won't actually be the single best performing stock from this group over the next year or 6 years. So that's my quick reaction.
No, I love that. And I fully acknowledge it's the least rule breakery of the 3 that I'm bringing for sure. But interesting one. I think it'll be a fun to throw into mix as we talk about
and
these.
One thing, I hope this doesn't extend the podcast too long. It'll be a brief point, but I realize we're running out of time. But I actually think it matters so much who the CEO of a company like that is. So you mentioned the founder stepping away, but whoever's the next CEO, like, is it going to be somebody like Satya Nadella or is it going to be somebody like Steve Ballmer? I mean, these things matter deeply, and it's true of every business, not just consumer-facing businesses. So if I were looking at this hard as a rule breaker, I would want to achieve as much clarity and confidence that we have a very special visionary person that's running this, we hoped for, rule breaker company, because most of the great rule breakers have such a person running them. It's very hard to crank out a great rule breaker and not have someone who's remarkable as a leader.
I think this is the worst stock of the group, and I'm willing to offer up a side bet. Yeah, the PCOR is going to be the worst performing stock of these 6.
I mean, I'm cheering all these on. Come on, Jason.
All right. No.
This is sort of our
$50. There's another $50 for the Fool Foundation on the line here.
All right. I'll take that bet. That's fine.
All right. Okay. All right. Our last stock here, BBB Foods, ticker TBBB. So this is a hard discount grocer in Mexico. And it's a really interesting story. The business has been around for, I guess, about a decade or so now. Just went public February 2024, I think, somewhere around there. So it's a relatively recent IPO. Stock's up 40+% since the IPO. It's down from the more recent highs, got caught up in a little bit of exuberance. Last year, the business has continued to really execute really well. Again, not purely a first mover, but in terms of the scale they're at and the market they're in, very much a first mover in that small format, kind of like the Aldi model to a certain extent in Mexico. They have 3,000 locations now. They opened 500 over the past year. Talking about growth, 20% revenue growth from their new store openings, almost 18% comps in the first half of the year. So extraordinary growth as they bring these stores up to scale, generate roughly break-even results. So they're doing a wonderful job of funding growth off the balance sheet and not burning a lot of money, right? So that's important. And it's the kind of business that as it gets to operating scale, the leverage you get, even at these lower margin businesses, you think about like the O'Reilly Auto Parts of the world and like these businesses kind of in the middle that might not get great margins, but they're really smart about managing their inventory, turning their inventory really, really well. And they can become wonderful, wonderful market beaters. The founder is still running the business. He has a substantial equity stake. So I think you have a lot of those kind of rule breaker qualities that are there, maybe in a business that wouldn't necessarily get viewed as a typical rule breaker and just a hard discount grocery store.
Well, I always like finding analogs. So you said midway through there, Jason, Aldi of Mexico. So those who know Aldi, that helps us picture kind of what's going on here. We do that a lot as Americans. We say, he's like the Elvis of Lithuania.
Right.
I can kind of get that. I mean, it's hard to picture, but you helped me. And so I do like having that kind of pattern recognition. And, Aldi is privately owned. I think it's a German privately owned part of a conglomerate. So I don't even know how to separate out its statements. And I haven't looked at it, but I would be, if I'm going to say Aldi Mexico, I want to know that Aldi has been a really big winner.
Right.
I know it's expanded. Like, it's a German, really high discount grocery store that I see in North Carolina. So clearly, like, they're doing something right. And is Aldi a great market beater over the last 15 years? I don't know, but you'd want it to be if it's the Aldi of Mexico. And I like foreign companies. We as Americans tend to focus on things we see close at home. But some of my best picks, Mercado Libre, have been companies that I don't get to buy from, but I do see them as an analog of other success stories. So sounds like fun. Each of these companies is doing something good in this world and helping people. And I want every company in stock to succeed. I'm not hating on a stock that I don't own or anything that's not a rule breaker. All of these are wonderful businesses, and for them even to rise to the point, Warby Parker, that they could be a public company, even as a small upstart, is kind of beautiful. What do you got, Jeff? Stock number 6.
Speaking of international companies, Coupang, CPNG is the ticker. I hate saying it's the Amazon of South Korea because that gets just to your earlier point about the Aldi of whatever. However, the way I would frame it is if there was a company that studied the things that Amazon did the best, like its top traits, and implemented somewhere else, that's what Coupang has done. They've really gone heavy into the logistics aspects of running an e-commerce business, so they can reach like 90% of the population within 1 or 2 day delivery. They have a fun pickup when you return stuff. You just leave it on your front porch and they come get it. You don't even have to leave your house. But they're adding on, so that's the bulk of their business, but they're adding on a lot of the Amazon-esque things, right? So there's a subscription service that gets you faster delivery. They do deliveries of groceries. They have a food delivery service, Coupang Eats. They're starting a streaming media platform. So you can see a lot of the hallmarks of what's made Amazon successful, dominant in South Korea, branching out into other parts of that part of the world. Taiwan, I think, is their most recent sort of branch out beyond South Korea. This one, unlike Procore, I think actually does check a lot of the boxes for rule breakers, but that's my third pick, rounding out my 3, Coupang.
Well, it's funny you mentioned that because, as you guys mentioned, I finished my stock picking at the Motley Fool in May of 2021. That means in April of 2021, one of my final picks was Coupang. And this was rule breakers especially was a team effort, so it wasn't my personal pick, but I was the one making the final call on everything all the way through. So I'm sorry to say for me and our members that I picked it at 42 and it's 28 today, guys. So I'm down 33% on Jeff's stock number 6. And I thought it was actually on potentially the Far East, a breakout company. It's still early days. And while I didn't make a great selection of it just before finishing up stock picking, I'm happy to say that team did re-recommend it.
It did. That's right. In the scenes. Yeah.
Exactly. And they're winning. So they went against my rule breaker principles because I add up and I don't double down. And in this case, they decided to add to that losing position, and now it's a win. So, it's always sounded like good positioning. I like that area of the world a lot. In fact, I love places that love business. Yeah. I love countries that encourage entrepreneurs. I think that's the single best thing you can do for human flourishing, is to unleash the creative geniuses that start new businesses with better products and services than we've grown up with. And that's basically the story of humanity in a lot of ways, and why the stock market goes lower left to upper right over any meaningful period of time, but not in every country, not in every region. And it's the ones that really encourage business, that love private sector. And Coupang is obviously part of that culture that I appreciate, even though I myself am down 33% on Jeff's stock number 6. So
There's still time. There's still time. If we've learned nothing, David, it's that if we have time for this to turn around.
My friend, you're absolutely right. And that's something that I hope everybody is learning from you guys on a regular basis and takes away from our work at the Motley Fool, is you should be playing the whole life game of investing. It's not about a quarter. It's not about a year. It's not about what age you got started. It's about the 50 years after that. And it's really all 50 of those years and being invested all the way through. I think that's the way to win. In some ways, our stock picks or the choice of this ticker over that one is almost secondary to having proper habits of regularly saving and adding and not head fake getting out of the market or listening to people telling you to trade. I think, to close, trading is the antithesis of investing, and most of the financial media today is just covering trading and encouraging trading. What you guys are doing is different. What we're doing is different. It's investing. And so I would say it's the habits that we develop, which is why I lead off with those in my book.
Yeah.
The habits you develop, even more than the stocks that you buy, which ones are going to really be what leads you to financial freedom. So this is fun. And I say a year from now or so, have me back. Let's look and see. You guys have to determine exactly what day you're starting. Like I need it to be a full game. I'm not sure which day but I want to see it in a spreadsheet, and we want to follow it and see how they do.
So we'll make a spreadsheet. We'll have a Google document. It will be linked in the description and the show notes.
Nice.
So we'll be there, and I think we'll
like
probably
all of our contests completely publicly available at all times.
Beautiful.
All of them. All of them.
So capital F foolish. I love the transparency, and this is so much fun, guys. Thank you for inviting me on. You know we love the subject. I know you guys do too, and you're creating the love every time that you come back out with your next podcast. And thanks for including me in this one.
Well,
David,
thanks for coming on.
Yeah, thank you so much. Again, Rule Breaker Investing publishes and is out for purchase on September 16th.
But you can pre-order it now.
Yeah. All right, David, again, thank you so much for coming on. Can't wait to have you on to see Jeff write that $150 check to the Fool Foundation.
Thank you, Jason, and thank you, Jeff, and Fool on, guys.
All right, everybody. As always, we love to give our answers to these hard investing questions. Have legendary investors and all around nice guys like David Gardner come on to give their answers as well. But we always like to remind you, it is up to you to find your answers to your questions about investing for your life and your family. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.